at 4.1%. To talk about it and to talk about why he's bullish on U.S. stocks, we're joined by Eddie Ghabour, CEO of Key Advisors Wealth Management. He's joining us from Delaware. Eddie, thanks a lot for joining us. First of all, your take on the jobs numbers showing the figures clearly showed a more robust employment market than economists were expecting. Both the number of jobs added to the U.S. economy was greater than expected, and the rate of unemployment came in softer than expected. What's your takeaway this morning?
So our takeaway is right in line with the thesis that we've been beating to drum to, is the fact that we are nowhere near a recession here in the U.S. And there's a lot of folks that continue to point to some softening data, and we've seen it as well too. But at the end of the day, the labor data continues to be strong and continues to prove the bears wrong. And we think this is going to just continue to add fuel to the bullish case for the equity markets over the next 12 months. Now, on the flip side, President Trump is not going to get the rate cut that he wants in July, in our opinion, based off of this data. So we would expect the Fed to probably cut in September. That's what the bond market is pricing in as regards to a higher probability. But this number really should be celebrated for the bulls, as well as those that continue to support this growth that we're seeing here economically.
Your view on the Fed and what it does on July the 30th has changed this morning, I gather. I've looked at some of your prior notes, and you thought a cut on July 30th was possible. Now you think that's, like the market, you think that's off the table.
I do. We were thinking that they would possibly capitulate due to the pressure they're getting from D.C., as well as two Fed officials came out over the last 2 weeks saying that they could justify a rate cut in the month of July. So we were raising our probabilities there. But with this job number and unemployment rate, and the fact that they revised the last 2 months employment data up as well too in this report, I think it's going to be a really tough challenge for them to justify cutting rates in July.
Okay, nonetheless, despite the fact that the market would love to see a rate cut in July, you are very, very bullish on the market. You think the S&P 500, which is now in record high territory at more than 6,200, is headed to 6,600 before the end of this year. And you say your message to investors is buy the summer chop. That sounds like advice to buy dips, correct?
That's exactly right. You know, we're not going to go straight up. Typically, you do get some seasonality weakness in the month of August and September. And if there's any hiccups in regards to trade, we have trade deadlines that we're going to see next week. But the fact of the matter is, in our opinion, that supports this thesis is so many people have missed this rally, and there's so much cash on the sideline that these dips are going to be more shallow than normal because they're being forced to buy. And this is why those waiting for a big drop have been frustrated, because of the way that the market is set up now. Too many were offside. So these dips that we'll see this summer, I think, is an attractive opportunity for those that have not participated like our clients have over the last few months.
You also say that the big piece of legislation that's getting so much attention really from around the world, the taxation and spending bill in Washington, which gets all kinds of criticism from some quarters for reducing taxes and driving up spending and widening the deficit, the fiscal deficit for years to come. You think that if you look at it from a market point of view, it is very market positive, correct?
It really is. And again, I don't like the fact that deficits are exploding, and there will be a huge price to pay sometime down the road. But our job is to evaluate what it's going to do in the intermediate term. And essentially, when you look at this bill, you're going to have taxation reductions across the board, and you're going to see deregulation, and you're also seeing massive government spending. And all of that does is go into the economy, and it's a liquidity bomb that's going in. It's a bazooka of liquidity at a time when you're not in a recession. And it's very rare to see this. The last time we saw something of this magnitude was during COVID. We had the COVID crash, and the Fed and the governments came in with massive liquidity. Well, now we're getting a lot of liquidity accelerating into the market in the coming months at a time when you can argue the economy doesn't need it. So that's going to inflate asset prices to levels that I think will far exceed many's expectations, and probably ours as well.
Okay, we've got about a minute left. Talk to us about JP Morgan. I know that's one stock you like.
So financials, I think, are going to really benefit from a non-recessionary environment, but more importantly for the banks, as you're seeing some deregulation. JP is best of breed. I think Diamond is one of the best CEOs on the planet. So that's a name that we really like.
Okay, we've got time for Microsoft. That's another one you like.
Yes, I think they will be one of the leaders in the Mag 7. Microsoft Azure, their cloud computing network, was the drag on their stock last year. And now with the revenues accelerating there, you are seeing a tailwind now for this company. They're a large cap name and they're a big spender in AI. And I think they're going to be a leader and continue to lead for our clients the rest of 2025.